Well, thanks for tuning into this special conversation on Bloomberg Quint. The US yields, the bond yields have touched the 3% mark. There's a lot of geopolitical news flow which is impacting crude, which is impacting the dollar and the resultant impact on emerging markets as well. So lots to talk about with our very special guest. Mark Matthews, needs no introduction, joins us right now on the show. Mark, good having you. Thanks so much for joining in. Starting off with the big elephant in the room, 3% is here, and it's looking like it's not resulting in some bit of buying into the bond markets as a result of the yields moving up to those levels as well. What's next? Everybody was predicting a doomsday scenario when this event finally happens. What's your prediction over the next 6 months?
I don't see why it should be a doomsday prediction. I mean, for the vast majority of the history of the 10-year Treasury yield, it has been much higher than 3%, like around twice as high on average. So 3% is still, I think, not a lot of money when you just sit back and think about it. Would you be satisfied with a 3% return per year? Maybe for 1 year you would, but for 10 years, you'd probably, want to look for things that give you a higher return. So I think after we digest this number, because it is a psychologically significant number, we will get used to it, and life will go on, and we'll realize that it's not such a big deal. Typically, where stocks get impacted by the Treasury yield going above a certain level is actually not till you get to about 5 or 6%.
Interesting, Mark, you say that. So there are two ways to look at it. One would be what happens to the US stocks, and arguably the whole conversation about how the tax breaks definitely come back and help the US corporations mitigate some of the borrowing costs that may have risen as a result of the yields moving up. But two, the impact on flows out of other markets back to the US because of the rising yield. How does that situation look like now, where we are at 3%, or over the next 6 months where we may be 3%, we may be 3.5%, or we may be lower than 3%?
If you look at the various government bond yields in the world, in fact, there's no other developed economy that has a higher bond yield than the United States. It's 3%. And I think New Zealand's the next highest at 2.9 something. So I do think that, it's a wide spread that could entice some money into dollars, but would people go out of their way to buy 3% versus, 2% in Singapore or Canada, and then put it in the stock market? I don't think so. So I think we're talking about two different kinds of money, bond money and then stock money. And the money that goes into stocks, which is obviously willing to tolerate a higher amount of risk, I think it will still continue to flow into other places in the world because, number one, the U.S. has done phenomenally better than anywhere else in the world, so it's quite expensive. Even though there are the tax cuts, it's still much more expensive than Europe or most places in Asia. And number two, we have to remember the story isn't just about the United States, particularly with the rise of the Chinese economy over the last decade. China was a $3 trillion economy 10 years ago. It's around a $13 trillion economy now. So it has a big impact as well. And it's doing quite well. So that is very supportive for Asian markets, almost all of which China's the #1 trading partner now.
Interesting. Interesting you say that, Mark. I'm just using India as an example here, but maybe the case has been for some of the other emerging markets as well. It's not been a particularly good year for flows. Calendar year 18 has not been particularly good for flows. In fact, if anything, on almost every alternate month until date, we've had reasonably strong outflows out of India, at least, and a clutch of other markets too. What would you attribute this to? I mean, would this be because the markets are looking slightly expensive on a case-to-case basis, or is it a general shift towards developed markets because even those are showing growth?
Well, having said Asia is singular, in fact, it is not. And India is very different from the rest. I do think India is in its own orbit. Number one, because it's so big, so it is much larger than any other market outside of, it's much larger than the Southeast Asian markets, for example, and the domestic economy there is really what drives the market, and so the economy is less subject to the vagaries of what goes on with exports and imports in other parts of the world. Having said that, you wanted to know why foreigners have been selling. I don't exactly know the answer to that. They were net sellers throughout the second half of last year, so it's really a continuation of a trend that was been in place for some time. I don't know why they were selling last year, because we liked the Indian market last year, and we still like it now, but I know this year they've soured on it somewhat, and I think the twin drivers are the rise in the oil price and the knock-on effect that will have in terms of the government having to cover the oil marketing companies if they fall into loss. Number two, politics, especially after the Gujarat election, starting to question the BJP's ability to pull off a victory of the same magnitude that they did in 2012 in 2019.
Okay, I'm going to come to that in a bit, Mark. Just one word on what's happened recently on the currency front as well. We've seen significant dollar strength. The last 1 month, the Indian rupee arguably has been one of the weakest performers in the Asian market or the emerging market pack as well. What's happening here, and do you think the trend of a strength in a dollar vis-a-vis a clutch of other currencies is likely to continue?
Our feeling on the dollar is fairly agnostic. We don't have a strong conviction on any of the major currency crosses right now. But I would go back to what I said earlier, that 3% is much higher than you're getting in any other developed economy apart from New Zealand. So the dollar, I think, is well supported by that yield. On the other hand, will it really go rocketing higher? I'm not sure about that either. So with regard to the rupee specifically, what's changed is the minutes of the RBI's meeting showing a more hawkish tilt, and so greater likelihood of rate hikes in India in the second half of this year should help support the rupee, as well as the higher yields in the bond market. Foreigners have been selling them, and I don't expect them to come rushing back, but the more yields go up in India, certainly the more attractive it looks.
Interesting, and interesting you make that point that despite the yields moving up the way they have, we haven't particularly seen inflows coming in a big way. The limits have been opened up ever so minutely as well. Just one more global question before I move full tilt to India, Mark, and that's on the commodity pack as well. Crude has risen quite considerably with all that's happening on the geopolitical front as well. The talk of US, Iran, and the conversations thereof coming off or pulling out of the deal. What do you think happens to that elephant in the room?
Yeah, I wish I could find something exciting to say, but it's pretty much the same as the dollar. We're agnostic. So we are neutral on oil, which I must admit is a change. We now are looking for about $65 on the barrel. And I think there are three factors at work. The first is one you alluded to, which is Iran. Iran has pumped about 1 million more barrels per day since they lifted the sanctions. And of course, recently there's been a lot of talk that the sanctions would be reimposed as Trump clearly has taken a much more aggressive stance on Iran than Obama. But Macron, having just left Washington, now it sounds like Trump may not. So that's a bit of a wild card. Number two, we are seeing very good discipline on the part of OPEC and Russia in their production cuts. And I don't see that changing. And number three is the inventories in the developed countries have basically come back to zero. Putting it all together and adding on pretty decent global growth, I don't see why the oil price should collapse. But as I said, we're not looking for it to go much higher either. So we're looking for it to flatline around here.
Interesting. I heard you mention that you are reasonably bullish on India. You liked India then in late 2017. You like India right now. There is this problem of the twin deficits. We've seen crude do what it does and the resultant impact that it has on the Indian economy as well, as is probably evident in the way the rupee and the bond yields have performed too. What makes you bullish on India, Mark?
Well, it's the bunch of things. I mean, number one is just the long-term structural story of the large and relatively young population, and that's well known, so we don't need to go into that. Number two is the reforms, and I do think that, I don't live there, but I've heard plenty of stories about how there have been a lot of execution problems and hiccups in the reforms, but you can't deny that they're there and they're happening and they are having a positive impact. And I think they will continue. I think that people vote differently on a state level than they do on a federal level, Delhi being an excellent case in point with the AAP party. So I'm not too worried about next year's election, even if BJP wins slightly less than in 2012. I think they'll continue to push through the reforms, and that's a good thing. And then the last thing is that the earnings are very robust this year. And I think since 2014, the consensus has been continually coming in too high. But what we're seeing in the most recent results is that the consensus is basically the actual results are meeting expectations. So it'd be nice if they were beating them. They're not beating them, but they're coming in line for the first time, as I said, in 4 years. And we are looking at growth in earnings in the high teens this year. So those are factors that I think. One last thing I might throw in is that you still have very strong domestic fund flow. Probably about a third or a half of that is SIP funds, which are sticky. They will continue to put money in the market regardless. So I think there are enough positives actually to outweigh the negatives that we discussed earlier, and therefore I wouldn't want to get too bearish on it.
No. That's music to the ears. Mark Matthews, many thanks for joining us today and speaking to us at Bloomberg Quint.